Hey folks, Dan Frio here with your real estate update for October 19th, 2023. So Kyle Seagraves and myself, Kyle is from Win the House You Love. He's a partner here at the with our group. And we did a live event last night. And the number one thing people continue to ask is, Dan, what's going on with these rates? When will they cool down? You know, what exactly is causing interest rates to go so high? And what is your expectations for mortgage rates maybe in 2024? Because we're basically at the end of 2023 right now. So I want to really go over that in detail today to explain to you guys really what's happening behind the scenes that's causing mortgage rates to go up and up and up. So as you see right over here, the mortgage rates did top the 8% range. Honestly, last year, if you would ask me this, I'd be like, there is no way it's going to get to 8%. But we have a lot of things out of control at this point. We have the Federal Reserve that's basically out of control. We have the federal government out of control, and we still have consumers that are flushed with money, and that is causing inflation on all levels. So I really want to break down in this video the cause and effect of a lot of these things. So let's really take a deep dive into what's happening in the markets. So if you go to the stock market and you watch the markets on a daily basis, they're basically, one day they're up 500, next day they're down 500. Today they're flat. The main reason why they're flat, if you look all the way up to the top, S&P rises slightly as traders await news from the Federal Chairman Powell. He runs the Federal Reserve, and he's going to talk today and just give us hopefully some insight into what's going on. But I've taken a lot of flack from people. They're like, Dan, you keep saying that, people have too much money and there's too much stimulus in the economy. And I get a lot of backlash in regards to the student loan forgiveness programs. But I want to show some numbers to you, and maybe you guys can figure this out for yourself. So the first thing I want to talk about is how the consumer has a lot of money, and this is really driving the Federal Reserve nuts. So if you see through here, net worth surged 37% in the pandemic era for the typical family. So I've been saying this for a long time. Well, at least the last couple of years, and people keep denying it. They're like, Dan, we're not flush with money. Well, this article was just posted when? Well, today. So I'm going to show you other details and take a little bit deeper dive into these. But if you go down through here, it's basically the reason for it is the growth was the highest on record, fueled by higher homes, stock prices, and pandemic era government stimulus. So a lot of the stimulus was the federal government was pumping out money to families every quarter. And they also had a couple different programs that I talked about on some people's YouTube channels in the past. And those people basically took down the videos because they didn't agree with what I said. Well, what I said was, you're going to have inflation creeping its ugly head. And I was saying this back in 2020 and 2021. I said, you're going to have inflation kind of running out of control because of all this stimulus that we're seeing in the markets. We had the governments, like I said, sending out stimulus checks. It's validated right there. Okay, then what you also had is during the pandemic, you had student loan forgiveness, where people didn't have to make a student loan for up to 3 years, and it just started back up just recently. And then also another big caveat of this is you had homeowners that didn't have to make a mortgage payment for almost 2 years. So if you were affected by COVID, or even if you weren't affected by COVID, you could stop your mortgage payments and there was no backlash. So basically you didn't have to make a student loan payment, and you didn't have to make a housing payment or a mortgage payment if you had a mortgage. So that flushed our economy, and proof is in the pudding right through here. Other pieces of this puzzle is right through here. As of January, and I know it's January, it's October now, but as of January, there is still $90.5 billion of COVID money still needs to be spent with no expiration. So the government said, okay, here's the states and local governments. Here's all this money. You guys do with it what you want, where we won't have any expiration on it. And, just help your infrastructure and do these things. I'm not against that. But when you're in an environment right now where the Fed's saying, well, we need people to lose their jobs and we need basically people to run out of money. When you're sending out $90 billion in aid and it's still available to people, you still have a lot of money out there, especially with companies that they can continue to hire to use up this money. Because if you give it to a state and you're like, okay, here's the money, you either use it or lose it, they're going to use it. Okay, then here I'm going to get in some trouble right now, but I'm going to at least give you guys the facts. You go over to this other piece. How much money are we spending in aid throughout the world? Well, just Ukraine alone, we've spent over $76 billion. Okay, so do they need it? Yes, but are we in the position to really start giving money away that we don't have? That's why we have a deficit. We have a deficit because we don't have enough money in our in our U.S. savings account to be giving this money away. But the hits keep adding. A lot of people keep bashing me about the student loan debt. They're like, Dan, it'll help our country. Well, it's also going to hurt our country because it's going to cost almost $475 billion. Okay, so do you get what I'm saying? $475 billion for that. We have $76 billion for the Ukraine. We have $90 billion in COVID relief money still to be spent. So when you start looking at some economic numbers like we're going to see here in a second, you can see why, well, the unemployment rate isn't spiking and people continue to have money. So let's get over to the economic news that we have today. And basically the only thing right now is that we have is two things. Is the initial jobless claims. This is an area where the Federal Reserve it keeps saying we need more and more people to lose their jobs because we need them to run out of cash. Okay, and I just proved to you that the cash was in the coffers of consumers and it's running out fast. So we have that number coming in, and it wasn't as dismal as people were hoping. The last reading was there was 211,000 people filing first-time job claims, and it was supposed to uptick just a tad to 212. It actually came in at 96. Okay, so but the other thing you want to focus in on is how much production are we getting out, or how many companies are looking at driving up production? Well, we see the manufacturing index, it is plummeting. The last reading was negative 13. It was supposed to come in at negative 6. It actually came in at negative 9. Negative 9. That means our manufacturers are contracting. They're producing less and less and less. So when that happens, you're thinking, okay, if they're producing less, it's because they don't need as many goods and services. So they're going to have to start laying off people eventually. So that's the whole kind of goals here, but this isn't trickling through. It really doesn't make sense. If you look at it, manufacturing is way down, but not a lot of people are losing their jobs. So there's kind of a conundrum right through there, and that's what we're monitoring on a daily basis. So with this data in right now, what's going on with the markets? Well, the markets are still flat right now, and it's waiting Federal Chairman Powell's speech so that he comes out later today. So with the data that we do have, what's the markets doing right now? Well, I expect them to be flat. Well, we have the MBS is down just a hair. That's really nothing in today's world. We're seeing usually fluctuations in the MBS market of at least like 30 or 40 a day, and I haven't seen that in my 30 years of doing this. But we're just seeing on the screen right now, we follow this right here. It's a mortgage-backed security bond. Why do we follow that? Well, because this bond, the yield on this bond is the biggest component of your mortgage rate. So if we follow this bond, we can see the direction of where rates are going. Right now, well, to give you an idea how this works, the price of the bond and yields have an inverse relationship. And here, let me explain. As the price of the bond goes down, that means yields or your rate is going up. If you look at the last, let's say 5 days, it's been just dismal. Rates have gone up about almost 1% in the past 30 days. I haven't seen a 1% adjustment in the last 20 years. So to have this big of a run this fast, there's a conundrum. There's just a misconnect in the market right now. So that's what we're monitoring. I think this market is way oversold, but with the government doing what they're doing, they keep spending the money that they don't have. They have to continue to issue bonds, Treasury bonds, to fund all this stuff because us as a country, like I said, we don't have this money in our savings accounts. We have to borrow the money. How do we borrow? Well, we issue Treasury bonds. We issue more bonds going out in the market, and there's not enough investors out there to gobble up all these bonds out there when it comes to corporate bonds, mortgage-backed security bonds, and now Treasury bonds hitting the market by the trillions. So that's really what's behind what's going on with mortgage rates. So today we'll have a better understanding with where the Fed is after Federal Chairman Powell speaks later this afternoon. You'll see some market reactions at that time. You'll either see the stock market go way up or way down right when he speaks because they're going to dissect every word that he has, and that's what I try to do on these videos every day is decipher that information for you guys. So where rates are going to go from here, honestly, I don't know. There is so many missing pieces of this puzzle that we're trying to connect on the back end to figure out what's going on. But the markets will settle down eventually. But we need to get past a lot of these obstacles we're seeing right now in our country as well as the world. So That being said, sorry for the gloomy update for today, but if you're still out there and you're like, hey, Dan, I would still love to buy a house. I hate renting. We would love to help you. Or if you're out there and you're like, Dan, I'm buried in debt. I have a ton of equity in my house, but I'm also buried in debt. We've been overdoing it as a family. We're overspending and we just need some relief. We'd love to help you in all those avenues. So how do you access equity in your home to pay off, do some consolidations to pay off those high interest rate credit cards? I'm not telling you to get in any more debt. My goal is to help you be a good steward of your money and to do what's right and make the best financial decisions on how to, put all that debt together, maybe in a low interest rates tool to help you save some money in the long run. So if you're out there looking for maybe a home equity loan, a bill consolidation loan, or even if you're out there looking to buy your first house, we would love to help you. How do you do that? There's 3 ways to reach out to us. 1, you can apply now right over there, hit the apply now button. Or 2, you can go to the bottom of the website. If you're out there saying, Dan, can I call you? Can I email you? Well, absolutely. You can do both of those. If you scroll down to the bottom of my website, you're going to see our phone number. It's 844-775-5626, or you can reach me personally at dan@therateupdate.com. Thanks so much for watching, guys. God bless. Have a great day. I'll see you tomorrow. Bye-bye.